Silver crossed $40 on August 29th, marking the first time it's traded at that level since 2011. Supply chain strains paired with new tariffs on copper have created a rare mix of limited supply and sudden demand. Institutional buyers rushing to secure physical silver have fueled EFP premiums and opened profitable arbitrage windows, pushing prices to levels unseen in over a decade. The question now is whether silver is preparing for a rematch against its prior all-time high, or to retreat below $40 an ounce. If you value clear-eyed analysis of the forces shaping precious metals, consider subscribing. Your support helps us continue bringing the stories others don't tell. Thank you. Silver has earned its share of skepticism, and not without reason. Anyone who bought at the 2011 peak has waited 14 years just to see prices revisit $40. Meanwhile, the S&P 500, gold, and even cryptocurrencies have set repeated record highs, making silver's performance look stagnant by comparison. But for those who accumulated during silver's long bear market, the returns now are compelling, and a retest of prior highs could make the case even stronger. Both of silver's past rallies toward $50 were born from extraordinary conditions. The first ended in the market turmoil of Silver Thursday. The second came during the aftermath of government bailouts and stimulus when investors rushed into hard assets in anticipation of runaway inflation. Today's rally has a different catalyst, though the undertones are familiar. Tariffs are pushing demand higher just as structural supply deficits enter their fifth consecutive year. The current rally in precious metals reflects a convergence of political, financial, and economic forces. As silver breaks through $40, gold is retesting its own record near $3,500 an ounce. Shifts in the labor market have altered the Fed's policy calculus, with Chair Powell acknowledging at Jackson Hole that the environment may now warrant rate cuts, a development that favors hard assets. At the same time, investors are bracing for the possibility that silver could face tariffs similar to copper. The year-to-date returns have been rich. As we prepare this video, silver is reaping a hefty 37% return, while gold is comfortably up 33%. The S&P 500, long the darling of investors around the world and the benchmark for almost all investments, is up just over 9% during the same period. The key driver for silver is the speculative froth generated around tariffs. Exchanges and institutional investors need physical silver for their contractual obligations. In a globalized world where free trade is the normal, silver can be stored overseas where the holding costs are lower. A silver can be shipped when it's needed to where it's needed. But if tariffs are implemented, the math quickly changes. On August 1st, the United States implemented a 50% tariff on copper imports, specifically targeting finished and semi-finished copper products while excluding raw ores and refined copper. The goal is to promote domestic copper production to protect national security, much the same way the government treats steel and aluminum as vital to national interests. Regardless of whether one likes or agrees with the policy, the logic behind it is defensible and, more importantly, widely applicable. The United States Geological Survey released a draft of the new critical minerals list on August 26th, including, for the very first time, copper and silver. That announcement jolted markets. Lease rates in exchange for physical premiums surged, and silver crossed $40 within days. The parallels with copper are clear, but they come with an important warning. Ahead of the copper tariffs, futures climbed to $5.59 by July 30th, in anticipation of supply disruptions. When President Trump announced the measures, along with exemptions for raw and refined copper, futures collapsed to $4.35 the next day, a 22% plunge in 24 hours. Institutional investors and exchanges are not chasing returns blindly. They prioritize risk management, often accepting lower profits to reduce exposure. The current premiums on silver reflect that calculation. But what happens if the perceived risk unwinds? Policy details will decide the outcome. The first possibility is that silver tariffs never materialized. Some gold imports were initially tariffed, though this appears to be a paperwork dispute. The president has pledged an executive order clarifying that gold will be excluded, though it has yet to be signed. Silver's case is less clear. While it carries both industrial and monetary roles, it was explicitly excluded from the reciprocal tariffs imposed on Liberation Day, suggesting there may be a precedent for exemption. Without an explicit statement, market risk may slowly dissipate over time, leaving a footprint in elevated prices for silver that remain for some time. The second possibility is that silver follows copper's blueprint. A high tariff paired with exemptions for the raw and refined products that underpin exchange settlements. In that scenario, the current premiums and arbitrage opportunities could evaporate very quickly as markets adjust to a clarified policy. The third, and least likely outcome, is broad tariffs that reshape silver's supply and demand fundamentals. Should that occur, today's move above $40 may prove to be only the beginning, setting the stage for a sustained rally and a potential retest of silver's all-time highs. Silver's future now hinges on policy. If tariffs never materialize, premiums will fade and today's rally may prove temporary. If tariffs are imposed with carve-outs, the market could see a swift reset, much like copper. And if broad tariffs take hold, the fundamentals of silver could be transformed, opening the door to levels not seen in more than a decade. In all three cases, one fact remains constant. Silver's role as both an industrial metal and a store of value continues to make it uniquely sensitive to disruptions in trade, policy, and finance. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.